Ashwini Agarwal, founder and partner at Demeter Advisors, joins in now to give us his views on how things have transpired so far. Ashwini, good morning. It's been great times for our markets and, celebrations galore, right? How are you feeling about the situation at hand? Do you think we can build on to our gains as we head into an election year? And what's the best way to approach the market now?
Good morning, Sonia. Thank you for having me here. It's very interesting because, if you recall when we last spoke, I had said that, the scenarios building up that the most improbable of the happening, which is a US soft landing, is what the market is now hoping for. And that hope has, crystallized in a significant way after the US Fed meeting last week. And of course, before that, we had the Indian state election outcome. So these two rockets, I would say, have propelled the market, over the last 2 weeks. And I think a lot of the cash that might have been sitting on the sideline has been put to work. Having said all of this, I think now I start to worry about valuations, and I'm starting to think that markets possibly getting a little bit overstretched. So as you say that next year is full of events, we have the general elections coming up towards the middle of the year. I think the outcome there is pretty much priced in. So I don't think anybody out there is expecting any bad news for the BJP at all. So that's almost a given for the market. So that may not cause much excitement. But what can happen, at least in the near term, is that foreign flows might become positive again. Having said that, we also have to pay attention to the kind of very large offerings that we are starting to see, both from the IPO market as well as offers for sale from private equity investors, promoters, etc., etc. You had alluded to some fundraising in the earlier comments just prior to my coming online. So I think on balance, I would say that this is the time to start becoming a little cautious. The upside is probably not a lot from here, and there are events over the next year which might prove to be disappointing relative to expectations. So, for example, on the Fed, one is expecting 4 to 5 rate cuts next year, and if they turn out to be just 1 or 2, then what happens? BJP election outcome we spoke about. You have the US general elections to contend with next year, and what happens thereafter. So, there are a lot of uncertainties, and I think with limited upside on a broad index basis, I think time to trim is here. That's how I think about it.
Okay. Well, Ashwini, I'm glad you brought that point up. Morning. That was actually my next question. Going into next year, we do have a lot of events to watch out for domestically when it comes to the elections, the Fed rate cut trajectory, and when they could also come up by. In that context, then, considering that you're getting a little bit cautious, would it be prudent to take some profits off the table? And if so, how much would you probably deploy, keep in cash then?
Morning, Ekta. The way I think about it is that, asset allocation is one great way to manage risk. And, at this point in time, what I'm doing is gradually building up my cash position, reducing equities. And that's how at least I'm doing it now. For retail investors and for a lot of your viewers, that may not be an appropriate thing to do because they are not watching the markets all the time, and for timing the market may not be the appropriate solution for them. But overall, I would say that increasing exposure to debt, for example, would be a good thing to do. Interest rate cuts will happen. Now, whether it's 1 or 2 at the Fed or 3 or 4, we'll have to see. But interest rate cuts will happen and they will follow through in India as well. So, getting invested in duration probably is a good trade to do. Therefore, increase allocation to debt. That's one way for your viewers to manage their exposure. Personally, I am raising cash. It is sometimes stock specific where I think the upside is limited from here. It is sometimes, across the board. So doing it gradually because, I'm also not sure whether the market will go up another 1,000 points from here or it will go up another 500 points from here. Those things are very difficult to tell. Usually what we have seen in January and February that you do have some renewed vigor in foreign flows. I don't know whether it'll happen this time or not, but that could be the one more leg up for the market if it were. But overall, I'm cautious, and therefore raising cash, increasing exposure to debt is what I'm recommending.
All right, you are cautious, raising your cash and also increasing exposure to debt. But those who are, looking at equity markets and places of safety in the markets itself, despite the run-up that we've seen, would you have any sectors in mind, Ashwini?
More than sectors, Mangalam, what I would do is go up the market cap curve and look at recent performance. So if there are stocks that have done nothing for the last 2 or 3 years, it's likely that their relative valuation gap has narrowed. And that might be an area to park your money if you don't want to reduce your exposure to equities. So some pharmaceutical names, some downstream chemical names, some of the frontline banks, these could be the areas where you could increase exposure to, still gain exposure to the market or keep your exposure to the market, but go up the market cap curve and look at stocks that have done nothing for the last 2 or 3 years, but fundamentally well-managed companies with no debt issues, etc., etc. I mean, those caveats I would say have to go with it, and that's how I would manage it. So sectorally, I mentioned banks, I mentioned downstream chemicals, I mentioned pharmaceuticals, maybe some IT as well. Though IT trade, I think, is pretty much done. Maybe a little bit of IT as well as a defensive position.
Okay, a little bit of IT as a defensive position. It's interesting, you are one of the first few voices expressing caution in this market, and I think it's sane advice given the kind of rally that we've seen. And I take your point about expectation management. Now, I mean, expectations are so high that the chance of disappointment is also high. But Ashwini, there's one narrative in the market that now commodities are going to pick up in a big way. A lot of people are talking about investing in gold in a big way. Silver could be the new gold as well. There are, recommendations on raising your exposure to silver ETFs. What are your thoughts on that?
Sonia, the materials space is something that has eluded my understanding all these years that I've been investing in the markets, because there are far too many global demand supply issues, global news factors that drive it. Now, let's take gold that you mentioned, right? Typically, gold has been an asset that does well when economies globally are shrinking or doing very poorly. So on one hand, we have a narrative in India that the Indian economy is doing very well, and therefore you should be exposed to the markets, capital goods, defense, government spending plays, etc., etc. On the other hand, we are also positive about gold, which is technically a contraindicator to economic performance, right? So the market in places doesn't make sense to me. So either one is right. Either the economies are globally slowing down, or they are not. So I think that's the narrative for gold and silver. But outside of that, I'm very ill-equipped to advise on metals and on commodities like gold and silver. I think they're good store of cash, and maybe if I join it with my opening comments that look, you need to take some money out of equities, then maybe gold and silver might be a place to park it if you're not interested in debt. But that's about it.
Okay, well, just keep your eye out on Piramal Enterprises, because that stock is now at the low point of the day, down around 4.3%. Well, Ashwini, I'm going to toss this over to you. The RBI tightened norms for lenders investing in AIFs or alternate investment funds overnight. And you're seeing the impact on these specific stocks come in. They'll probably have to increase provisions. They'll probably have to liquidate their investments. It depends on the lock-in. But your view, and how would you read it?
So I haven't looked at this whole, overnight development in any detail, and I just have to think over it a little bit. But for NBFCs in particular, what I would say is that I think regulation is still evolving in many places. And like what we saw, literally a month or so ago, where they increased the risk weights, where RBI increased the risk weights for certain type of loans. Regulation continues to surprise, and that's a challenge that all NBFCs have to deal with. So within financials, at one end I'm positive on the banks, and the other hand, it would be the services or home loans that I'm positive about. But the whole NBFC micro lending space, that's fraught with regulatory risk in a meaningful way, and that keeps showing up from time to time. and that worries me. So I tend to kind of avoid these as much as I can.
Ashwini, since you're in such a candid and cautious mood, and rightly so, given the sort of run-up that we've seen, let's hear out your honest views on the kind of IPO rush that is on. I mean, are you tempted in any of them? Because there's a serious fear of missing out. Most of these IPOs, being subscribed 50, 60, 70, 80 times with huge grey market premiums as well. What are your thoughts? Is there anything out there that you found interesting?
Let's start with Ireda. I don't own it. I've never bought it. But Ireda, debuted at whatever 50-60% premium to issue price, and then pretty much doubled within the next week or so. It went from being offered at 1.1 times price to book, and now trades at close to 3.5 times price to book, if I have my numbers right. I mean, I've never seen these kind of price movements. It's befuddling. Okay. The oversubscription numbers that you're seeing for IPOs, in the main board as well as the SME, they are mind-numbing. Some of the companies are good, but valuations are quite full. Insofar as subscribing to these IPOs is concerned, and you might have an initial pop and you might want to trade it, that's fine. It's a little bit of fun and games. It's a little bit of tadka on your dal, if you will, right? But this is really an indication of the froth, the euphoria in the market, and this is one of the reasons why I'm cautious, because when euphoria sets in, okay, that is when the beginning of the next fall starts to happen. So we don't know what will cause it. Okay, we will never know why market falls till the event is behind us. So I can't predict that at all. I can't even predict whether the market will go up another 10% before it starts to correct. That's impossible, right? But euphoria is a sign of trouble, and it always has been, and this time should be no different. Is my take on this whole situation.
All right, wise words there, Ashwini, and we'll take all of it in good stead. Thank you very much for joining in, and hope you have a great Christmas and New Year's as well. We'll see you in the new year. Thanks very much for joining in.
Thank you. Wishing your viewers the same. Thank you.